A lot of businesses that I've seen don't actually fail because they have a bad idea. They actually fail because they don't have cash. The old adage of turnover is vanity, profit is sanity, cash is king. So understanding what your cash flow position is throughout the beginning of a business and even established businesses is absolutely key to a successful business. Ultimately, what a chart of account is your income lines and your expense lines. So if you took a business like a training business, for example, if it delivered different training courses, then you could have a different income line for each of those courses. Similarly with your expenses, it's really important when you're looking at your chart of accounts to make sure that they're relevant to you. So use your language, because ultimately when you look at your profit and loss account, you want to be able to look at the certain lines in your business and identify with those quickly. You don't want to just use generic off-the-shelf nominal codes. So one of the things I do with all of my clients is we'll sit down, we'll look at their business, what are their income types, what are their expense types, and we'll review those, edit those so they're bespoke to your business. Establish what your variable costs and what your fixed costs are. So there'll be certain costs in your business that stay the same no matter what sales are, so things like rent, and that's very easy to map, because your rent is going to come out on X date every month. The amount's going to stay the same, and so that's very easy. But there will be some costs in your business that ultimately that vary, whether that's according to sales, whether it's wages with overtime, or whether it's material costs. It's also important to understand what your break-even point is. So once you've looked at all your fixed costs and any costs that are associated to your sales, it's important to understand what money is going to go out every month, every week, for you to be able to run this business. And with that, then you understand how many sales you need to make to ensure that you hit your break-even point, and then naturally anything on top of that will be profit. The reason why this is important to understand is because you need to build into your cash flow forecast VAT. So every quarter, typically, you would complete a VAT return, and depending on whether your income is higher than your expenses will depend on whether you have a VAT liability, or potentially in the early stages of business you will receive a VAT refund. And it's important to map out your VAT payments within the cash flow forecast, and also to include all of your expenses and income gross of VAT. So when you're looking at a lot of profit and loss accounts and things, they typically tend to be net of VAT, but your cash flow forecast should actually include that VAT, because it's going to be physical money going out or physical money coming in, but then naturally you need to then consider the tax implications on those VATable items in due course. One tip that you need to consider is if there's any cash gap. So it's all very well and good making sales. So let's just say we raise an invoice for £1,000 now. Sometimes you may be offering 14, 30, 60, even 90-day terms. So you need to understand raising a sales invoice is not the same as receiving cash. So you need to understand what money is going out and when you're likely to be paid invoices that are coming in, and also create what I call what if scenarios. So if you've raised an invoice for £1,000 and you're expecting that to come in within 30 days, if that isn't paid within 30 days, what is going to happen to your business? What is the impact on your cash flow forecast?